Good morning, everybody, and welcome back to Money in the Law, My FM 101.3 and Hollis and Cable Access TV. This is Money in the Law with your host, Jay Marsden from the Marsden Law Group, and I'm his associate and good friend, John Drohan. We've been doing this now for in our 9th year.
9 years, baby.
9 years. We've been bringing Money in the Law to you lately on Saturday mornings at 9 o'clock, just to tell you all the things that you need to know about the things you really don't want to talk about, which is money and the law. And we're the guys.
So
we're the guys that make. Not only do we make you want to talk about it, but we also make it fun, and we make you want to like learn more about it and ask questions. Ask the questions that you don't. I mean, everybody says there's no such thing as a stupid question, which we of course know that's not true. There are many stupid questions, but even if you got a stupid question, we're happy to answer it for you.
Yes, we will. Yes, we
And
will.
tell you
we
it's
come up with
stupid.
a few of them ourselves.
Every now and again.
Yes,
and we'll tell you it's stupid. So, how you doing?
I'm doing. I'm like jumping out of my sneakers. I'm so excited. This is my
And the reason
absolute
is,
favorite time of the year.
why.
I mean, if you're listening to this today, you are in the midst of Memorial Day weekend.
You're in day one. You're in plus one of Memorial Day weekend.
Right. That's right. It's like the beginning of the like the 2 weeks leading up to the Super Bowl. This is how I feel. I feel like it's the next 3 months are just like manna from heaven, baby.
And
manna
it's funny,
from
and you think about it, right? So, if you live down south, if you live in some of the warmer climate areas, you don't get. I don't think you get as excited about the summer. I mean, granted, you get schools out, and you get that business.
Sure. This.
But when you live in a place where it's cold, a good part of the year, or the weather isn't that great, a good part of the year, and then when summer comes, it's like, whew, it's you don't waste a day. The two places where I used to live, well, I didn't ever live in Minnesota, but I've been in Minnesota. My roommate from college was from Minnesota, and I went and visited him in the summer, and we were there for about 2 weeks, and I was like, that place doesn't mess around.
Yeah.
Minneapolis, Minnesota.
Oh, yeah.
Because their summer's about,
What, a week, 10 days?
Yeah, I was going to say 11 days long, but there's something happening. They do not waste time.
Yeah. Actually, Ray and I just were talking before the show, and he was like, Friday is when the gun goes off and the mask mandate changes, and you're now arguably you're free to move about the Commonwealth, and so everybody's kind of like, it's funny, you watch people who are like in like the service industry. I talked to somebody at the coffee shop this morning, and they're all kind of like, I don't know what's going to happen Saturday morning.
It's going to be weird.
It could be a bacchanal, or it could be just like pretty low key.
So now, as you're listening to this, there's probably just insanity going on.
There could be insanity. Look out your window. People can just be running around, maskless, screaming and yelling.
And if you're not like out, if you're in your house listening to this, get outside. Go somewhere. Go somewhere else.
Yeah, regardless of the weather. Go out, get a little rain, and feel a little rain on your face. It's not going to hurt you. It's not going to hurt you if it's raining. Don't worry about it.
Because you're not wearing your mask.
Yeah. So
Provided
it's a little weird.
Yeah.
So it's going to be, we've been meeting right along. So everybody who's come in the office has come in with a mask on, and we kind of have a joke. Oh, it's great to put a name at the third of the face. Ha ha ha. And everyone's like, and everyone gets it. Everyone kind of rolls with it. They're all, yep, that's fine. But I'm trying to describe what the analogy is. It's like one of those you're wearing like it's almost like when you're wearing an uncomfortable suit, and like when after the wedding, when everybody goes back to the room after the wedding for the after party, and you're staying over.
Yeah, when you're changing out of your, or if you're in the wedding party, you're changing into that rental tux that you've had.
Yeah, that fits like a glove, or if you're just in your own wool suit and you're like, I can't go. And then everybody goes back to the wedding. You probably get a couple of cocktails in you, and you're like, hey, let's go, let's change. And then you change, and it's like you're a new person.
Right.
This is potentially the same thing. You take this thing off, you'd be like, wow, I think I feel like I dropped 10 pounds.
I feel like I just took off my wedding dress.
Whoa, settle down. That's a different. That story has a different ending. It's a different ending. That's right. So
as I'm driving in and I'm thinking about, I'm like, one of the things that we don't really talk about so much is like where we are, like in our little Holliston area. Now, granted, we cover a wide base of a wide area,
very large footprint.
Yeah.
Yep, that's right.
But that Holliston area, right around where 847 Washington Street is, which is where my friend's office is, that it seems like as the weather starts to get a little better, that place starts to brighten up a little bit.
It perks up a little bit, sure.
It does.
Yep,
and one of the things that we see is one of the things that's happening down in Holliston is they're talking about doing some kind of renovation down the street and at Blair Square.
Oh, yeah.
For for the not late Bobby Blair. Bobby Blair.
Yeah.
which
Well,
I always,
which
I always love that story. So this,
with
of
us.
course, Blair Square was named after our dear friend Bobby Blair, who is also known as the ceremoniously as the mayor of Mudville.
Yes. Yep. That's right.
So Mr. Blair, when they dedicated the square to him, they had a big ceremony, and then I think you as a
I believe I had something to do with it. I believe I was involved in that to some
I think you
degree.
spoke at that as
Yeah,
well.
I'm sure I probably did. Yep.
So,
yep.
so as they're having this big ceremony, everybody, it's almost like it was a dedication ceremony to someone who had passed on, and I'm standing right there next to Bobby Blair, and he goes, "Yep, well, it seems kind of weird, but I'm not dead." Yeah. I'm right
in
here.
only the way Bobby can do it.
And only
right?
the way
Yep,
you can.
yep.
So they're talking about doing some kind of renovation down in the Blair
Bit of
Square
a town
area.
green vibe down
Oh.
there, and they're doing a whole bunch of stuff down there.
gosh, so
They've done a fair amount down there. Actually, it's funny. You look around, and there's even out the window here. There's, this is the season for the whole, the sort of the leveling up and the cleaning up and the greening up, and everyone's kind of chomping at the bit to be outside, and so this is going to be all part and parcel.
And it all
of it.
starts today this weekend on Memorial Day.
Yeah,
On
yeah,
Memorial
yeah.
Day.
So it's all good.
So on Memorial Day, what is it that you'd like to discuss with our fine listeners today?
So I guess the thing that, we always talk about things that have happened, things that have come into the office, what types of issues have you dealt with? And the one thing that we seem to be tasked with most recently is planning around large IRA balances. And
not the worst thing in the world.
No, not the worst thing in the world.
Not your biggest problem in life.
No. But basically, how to sort of handle them, right? How to think about, if you're trying to do some long-term care planning. We've talked about this on the show before, that the IRA, the 401k, that tax-deferred vehicle, is the best way, we think, to try to save and put away money for retirement, because all roads lead to retirement. But the challenge is that those monies become a little bit difficult to plan with because they're tucked under that tax-deferred blanket.
Yep.
And if you want to do something with them, everything you try to do with them becomes a real issue because this tax is involved in everything, and we know how much our clients don't like paying taxes, and they complain about it all the time. But we say, look, you got to kind of figure out what your thoughts are here and what your plans are here and what you think you're going to do. So just some of the planning considerations when you're thinking about some large IRA balances.
And a lot of times people often, they can kind of go overboard with it as well, right?
Sure,
They can
yeah.
say, because they start overthinking the whole tax issue, and they're like, oh my God, it's IRA. And almost rightfully so, in the sense that people look at that money differently than they do their other money, right? And because they're coached that way, they're taught that way, they're made to think that way. It's like, if you're putting money away into a 401k or any kind of employer-sponsored plan, it comes out of your paychecks. It's almost like you don't see it, right?
Yeah.
Your whole working career, you're kind of loading this thing up, and then you have it, and it's there, and you're retired. And you think that's not my money almost.
Right,
That's
right.
like kind of like money that's not real. Am I allowed to use that money?
Well, you bring up a great point. You spend your entire life not touching it, that when it becomes time to actually start using it,
feels weird, right?
For
Yeah.
all the reasons that you've been putting it away, you feel a
Right.
little bit, like, oh, I thought it was, and then you start to either not take money out, or you just don't know how to handle it.
It's kind of like when I turned 21. I was like, all this time I'm looking at these guys drink beer, and I'm like, I wonder what that tastes.
Is that? What is that?
Why is it so
What is that
popular?
amber-colored liquor?
Why is it so good? And then
Yeah.
when I was, I
Finally,
my birthday,
for the first time, yeah.
I'm
yeah,
like,
yeah.
wow, I
Probably didn't even like it. You probably didn't even like it. You're like, this isn't
I don't see that.
This isn't acquired taste. I'm not sure this is something.
I better try another one to make sure
Make
that
sure
I
they all
don't
taste
like
the
it.
same.
Yeah.
Maybe this one was bad.
This one,
Maybe I got a bad one.
All
Yeah.
right, I'll give it a fair shake. Yeah, exactly.
Who
the
knows? You never get a
the same
skunk
kind of-
one. That's the old, you get the old skunk one.
Well, you don't know what skunk is,
That's right.
You don't know.
That's
you
right.
don't,
And you don't care. You don't care because you're so poor. You're like, I'll drink it. Doesn't matter. I
drink a
I don't
skunk.
care how long it's been in your trunk.
Yeah,
this is
I don't
good.
care how many times it's been chilled and
Yeah.
heated and chilled and
How long
heated.
has this been sitting in your golf bag? I don't know why. That just tastes delicious. Tastes delicious. That's unbelievable.
Yeah.
So something to think
Same
about.
thing.
Something to
Right?
think
You
about.
go-
Yep,
I
something to
do.
think about.
I do like that because what sometimes what we see is, you're right. Like, people are kind of gun shy about what to do with, but they almost talk themselves, or they, of course, they get advice from their several uncles or other family members who are, who aren't necessarily
Google lawyers,
yeah,
Google
right.
financial
So
advisors.
they'll say, whoa, you don't want to do that. You don't want to, and so when it comes time to actually start using it, there's a right way to do it. There's a right way to do it. And again, it's different for everybody. Everybody's got their own situation, but there is a way. And don't be afraid. Don't be afraid to kind of like talk about it and understand, like, okay, there's probably different scenarios, different kind of courses of action that you could do when it comes time to start drawing on it. But understand, what are the ramifications, and maybe maybe a better understanding of the ramifications will enable you to be able to make a much more educated decision, which is why we're here. Which is
why we're here. Try to educate you and get you all.
So we'll talk about that right after we come back from a break. But before we go back in the break, I just have to say, I have to do a shout out to the Hollis and Cable Access TV.
Always.
And by the way, who's this guy over here? Are you new?
Are you new? Come on, is he new?
So I wanted to give a shout out to Hollis and Cable Access TV because they just did this big HCAT montage, and you'll probably see it. It's going to be everywhere. This HCAT montage of what HCAT did during the pandemic.
Nice.
So it's like this 4 minutes, and oddly enough, there may have been some snapshots of you and I, or your show might have been mentioned.
Nice, excellent, yeah.
Which, by the way, it almost looked like when I pictured it, when I saw it, you have this black background, and it looks like. I mean, I'm waiting for you to start pulling rabbits out of a hat. It looks like a magic act. Very good though. You look great. You look great. You look slim. You look good. You sound smart. But as I was watching, I'm thinking there's probably somebody who shot 85 to 90% of all that footage. And I think that guy might be in this room.
It could be.
That guy. So Christian.
Commander Christian.
I'll be willing to bet, and I'll bet Bruce, because Bruce will lie to me. I'd be willing to bet that, Christian, you probably shot 75% of that. At least, maybe 80. 80%.
He's being very humble.
80%. Right now, he's got his humble face on.
In his mind, he's like,
which is not much.
Sweet Bippy, I did.
It's not much different for those of you who can't see him. Not much different than his angry face or his I don't care face.
It's the mask face. You can't tell.
Yeah. Oh no. I can see through that mask.
From an expression perspective, he's sort of like the Bill Belichick of
exactly. He is the Bill Belichick of all camera work. Right.
That's right.
All right. So when we come back, we're going to talk about that big IRA. Oh, worst thing in the world. I'm sorry that you have this big IRA.
First thing we're going to get you is a transfer form. Let's get you one of those. That's right.
Why do you have that? I'm so sorry. I'm so sorry for your loss.
That's right.
All right. We'll be right back. Happy Memorial Day.
And we're back. My FM 101.3, Jay Marsden with the Marsden Law Group. John Drohan, Made Effort Financial. Christian steering us through the cosmos behind the camera, making us look 20 pounds heavier than we really do. Wait till next week.
Speaking of which, so right before the break, we were talking about the HCAT video montage, and they did have a clip of Money in the Law. And I'll tell you what, they picked the worst possible one.
Sure they did.
So
on purpose.
I'm looking at it, and of course, for many of you who, I fixed my hair, which was broken for several over a year. So, but I'm looking at this picture and I'm like, I get this old man sweater on. It's like, and I got long hair, and I'm like, wow, I look absolutely terrible. I look at 20 years older, right? And I'm thinking to myself, maybe Haley was right. Maybe
it was time. Maybe I should have cut that a little sooner.
Maybe it was.
That's right. Always listen to your wife.
So
Always listen to your wife.
There you go.
Yep, that's right. They know all.
All right. So
big IRA balances.
You got a big IRA.
It's great. Good for you. Good for you. Now
so is big, when you say big, what's the?
I mean, it's all relative. It's all relative. It's all relative. That's all relative.
It's big to you,
yeah,
right?
Yeah, that's right. If it's if it represents a lifetime's worth of savings,
then it's big.
Doesn't matter what the number is,
exactly,
right? Doesn't matter what the number is.
And that's important to understand, right? It's important to, for you to, because people are like, well, I only have X amount of dollars. You're like, well, that's what you were able to save, and in your circumstances, so that's what you got, right?
And those savings might match up exactly where they need to be, right? Based on your lifestyle, based on what you spend, based on what you think. It might work out perfectly. So it doesn't necessarily. It's irregardless of the number. Don't worry about that. We're just talking about
of the number.
Sizable IRA balances. Now the challenge is, what do you do with them if you're trying to do planning for example, long-term care, right? Those are the issues, right? And we've talked about on the show before how in most situations, husbands and wives are able to pass money back and forth, not subject to any look-back periods. Medicaid doesn't look at transfers between husbands and wives with any type of wary eye, right? They just say, look, husbands can give wives all the money they want to. Wives can give all the husbands all the money they want to. But when it comes to your IRA, that's not the case, right? You can't give you can inherit your IRA. You can inherit your spouse's IRA, but you can't give your wife your IRA.
Not while you're still alive.
That's right. That's right. Not while you're still alive. And if you do, you got to take it out of the IRA and you got to pay taxes on it. And then you can potentially sort of gussy up some of your planning ideas. But it's after Uncle Sam takes their pound of flesh. So you have to think through a little bit. You got to really have a little bit more of a future look as to whether or not you need to. One of the things you need to think about is, should I be accelerating my IRA withdrawals maybe above and beyond what would normally be a regular, boring old minimum required distribution, because there's a reason to draw down your IRA to potentially provide some planning flexibility.
Yeah, so remember what Jay's talking about here is he's talking about kind of that next level. This is the long-term care planning. So we're past, hopefully we're well past the retirement planning
Yes.
here. Because as we all know, your IRA, your 401k, that qualified money, that tax deferred money, its primary purpose is to help augment your retirement income, right?
That's right.
you know,
It's your retirement war chest.
That's what you're using to help pay for your retirement and in your golden years and take you off into the sunset. So what Jay's talking about is now you've started that, or you've been doing that, and now you're getting to this point where you could potentially be you could foresee a long-term care situation.
That's right. That's right. You're less concerned about retirement, if you will, or retirement income. Now you've brought this long-term care issue, this long-term care planning piece into the discussion, and this is where this starts to become an issue or a problem, if you will.
And don't mistake it. I mean, you don't have to wait till you're 80 years old to do this. No. This all could be a plan.
Be all driven by your health.
Yeah, it could be a plan that you're thinking about in your 60s. I mean, this could be something that you're at least considering, and you should consider it when you're as part of your retirement plan.
That's right.
When you sit down with clients and talk about, hey, we're going to talk about retirement planning. The idea, the subject of long-term care needs to come up. Now, right. Are you going to do something about it at that particular instance? Maybe not. Maybe you're not in a position to do anything about it. But at least you acknowledge it and you say, okay, what about and it'll be like, what about like long-term care? My mother, my father, both ended up in assisted living and nursing homes. It's something that I'm concerned about. We've had some. I've had.
We have a history, we have family history, things like that.
I've seen it happen. So what about that? And then you address that at that time and say, well, okay, right now here's what we can do. Here's what we can't do. Here's what I would recommend that you don't do, because you have some retirement stuff you have to consider at this time.
And what drives a lot of this discussion is the change in the rules, right? So before you would get an IRA, you would inherit an IRA, you would stretch an IRA out for the rest of your lifetime, for the most part, right? So you had this lifetime of continued, deferred growth. Now they make you close it all out and wrap it up in 10 years. So if you're looking at your retirement war chest, which remember is everything, it's not just IRA, it's real estate, it's money that you have in the bank. There may be
all those Cougarans that you have, you inherited.
Cougars, yeah, that's right. So what you're thinking about, what you need to think about is, look, how am I going to sort of spend my money, right? I have different pockets of money. How am I going to spend my money? There may be an argument that says, hey, look, what we would like to try to do is, because you can put protections on things outside of your IRA, like real estate and like liquid assets. So there may be a discussion that says, look, if we're concerned about long-term care, the answer may be, let's put some protections on our real estate. Let's put some protections on our liquid asset through the use of retitling the properties or gifting, or through the idea of irrevocable trust planning. And then let's use the IRAs, let's spend the IRAs the way that they sort of were originally intended to be spent down, right? You put the minimum required distribution in place, you combine that with other sources of income, and you say, look, we're going to protect our taxable stuff. That's the goal. Get that to the kids. We'll use the IRA, which is a little bit counterintuitive, because before it was always the opposite, right? You were trying to box that IRA in and really try to preserve that, because that was your.
Well, why? What's the main reason why you did that? Why I went to my IRA last?
You got this tax deferral forever.
Smart guy. He's
right?
Smart. It's like he studied for the quiz.
Almost studied.
He studied for the quiz. So you're right. Like that's it. So and that's kind of the thinking. And I still think that way in many ways.
Yeah.
Like that. I want to defer paying taxes as long as I can. Why would I want to pay my taxes sooner when I can put it off to a later date, right? But again, in some situations, particularly when you start really having to consider the long-term care situation, as Jay's saying, there may be another way where you could still, again, you want to, here's where I am now, here's where I want to be. I want to get to that.
Right.
This is what I want to see when all the dust settles. To get there, maybe I go about it a little bit different way because I do have a sizable qualified account. I do have this tax deferred account that if I can't directly, I can't gift this somewhere.
Right.
I can't give it to my wife. I can't give it to my
can't
kids.
redeploy it in its current state.
Yeah.
You just can't do anything with it.
Yeah. So and if I did do it right now, it could cause such a tax implication that it wouldn't be worth it, right?
That's right.
Right. So
and I guess my point is when we run into these long-term care planning situations where somebody says, the people at the nursing facility or the people at the assisted living, want us to start thinking about Medicaid planning, and they want us to think about filing from Medicaid or MassHealth to kind of figure this out. And then we try to tell people, as a lump sum distribution, what you're going to do is you're going to create, if you've got a $500,000 or $600,000 retirement account, you're creating, a $60,000, maybe more, $75,000 not tax problem, but you're going to pay a lump sum distribution to Uncle Sam. And then what happens is when you do your taxes next year, your tax guy says, you took a full liquidation of your retirement account. You have $600,000 of revenue on your 1040.
Guess what tax bracket you're
right?
in.
Yeah, that's right. You're in the millionth tax bracket. And then it also starts to mess up other things. You've got other premiums that sort of key off of your W-2 number, not your W-2 number, your 1040 number. And so now those get out of whack because, you weren't intending to make $600,000 in 2021, right? So this goes back to this idea of, we want to sort of target the things that we're trying to protect, figure out which assets make the most sense to protect, and then which assets are we going to live our life with, right? We always tell everybody, don't impoverish yourself, in an attempt to sort of beat the nursing home boogeyman. That may never show up. It may never happen. So let's kind of figure out a plan. And to John's point from earlier, this is because the long-term care part of this discussion is now beginning to outweigh the retirement income planning part of this discussion. So it involves a little bit of forward thinking, but that's what you want to be looking at.
Yeah, because remember, long-term care is expensive, right?
Yeah.
Long-term care, and it could be severely expensive if you end up in a nursing home situation, right? So the idea, and again, to kind of dumb it down for guys like me, if you need to go into a long-term care situation, you're going to go. Somebody's going to pay for it, whether you pay for it or whether the state pays for it. You're going to, it's not like they're going to leave you out on the street. So if you have to end up going into a long-term care situation, it's going to happen. But the question is how are you going to pay for it?
That's
how
right.
And when you go to your elder law attorney and you say, I'd like to do some long-term care planning because what I'd like to do is I don't want to spend I don't want to exhaust all my money if I don't have to. I don't want to, if my intent was to leave a legacy, to eventually to my kids, to my grandkids, how can I do that? How can I do that with my current situation? And as Jay's saying, what I'm going to ask him to kind of walk us through is, okay, what are the things that I can protect? What are the kind of the low-hanging fruit of the things that I can protect in a long-term, if I'm going to potentially face a long-term care situation? And then what are the things that really there's no way around to kind of, and there's in many cases you can't protect some things.
Right. That's right.
And one of the thing that we're talking about today is that qualified account. That qualified account that as it is right now, you can't put it into a trust and say, hey, it's an irrevocable trust, and now it's not mine anymore. It is yours, and it's got a named beneficiary. And so these are the things we're going to talk about to be able to kind of say, okay, if I'm looking at this long-term care situation, what can I say? What can I save, and what's potentially a technique if I have this large IRA, and how I can deploy that maybe differently than I would if I wasn't overly concerned about long-term care.
We taking a break?
I'd say we.
You look breaky.
Well, I mean, I don't look tired.
No. But you look like you're ready for a break.
Well, I did go to the gym today, and someone else didn't. But I'm not. I'm not
Wow.
going to say. I'm not going to. I'm just going to say.
Maybe I ran. Maybe I ran.
Maybe you didn't.
Maybe I ran.
Maybe that's it. You know what? Maybe he did. Maybe he
All
did.
right, we'll talk about this.
We'll
after the
talk
break.
about this during the break.
All right.
All right. We'll be right back.
And we're back. Money in the Law, My FM 101.3. Jay Marsden with the Marsden Law Group. John Drohan, Main Effort Financial. Christian steering us through the cosmos, getting us from point A to point B. And we're talking about large IRA balances. I got a question for you, oh Sage One. We've talked on the show
answer is
before.
yes.
We've talked on the show before about these hybrid long-term care insurance policies and how to sort of deploy those as a way to put a wall between your money and the potential nursing home situation and things like that. How do you feel about somebody, rather than being forced to take a $600,000 gigantic distribution from their IRA to do some Medicaid planning, how do you feel about somebody taking, let's say, I don't know, $100,000 or $75,000, some number out of a retirement account to pay for long-term care,
Insurance.
those types of policies?
Or to pay
Yes.
for long-term
Yep,
care.
yep, yep.
I again, every situation is
Unique.
individual
Yep.
and unique. However, I'm not against that at all.
Right.
I'm not against that in the sense that if it makes sense, if it makes sense financially, I'm not against people taking their money out.
No.
and
I'm
spending
not
it.
saying you are. I'm not suggesting you are.
And that's an important thing. Like and we talked about it in the beginning of the show. Like I've had this IRA for like all these years, and now I'm like afraid to go and use it
Sure,
because
yeah.
that's the money I've been saving. Look, you heard it here. Money was made to be spent, and if the time is, or if the opportunity's there for you to spend some of that money, and maybe you have to spend more than just your monthly income that you're taking out, and it works according to your plan and it supports your short and long term goals, then oh yeah, absolutely.
And so in that scenario, what we're really talking about is somebody who's turning, you're over 59 and a half, there's no penalties, anything like that. So you're in that sort of time frame where consideration of a long-term care insurance policy could make sense, right? And so you say to yourself, well, you know what, we've accumulated some resources, we've done well, we've moved away from life insurance. We always talk about this, right? I mean, your whole life you're covered by insurance, right? Covered by insurance the day you show up. In some cases, you're covered by insurance the day you walk out the door.
Yep.
And then in the interim, you're covered by health insurance, you're covered by life insurance, you're covered by dental insurance,
Auto insurance.
auto insurance, right? So at
Yeah.
some point, you get to the
That
step
Lords
in the
of London
process, right?
insurance too, like for your valuable paintings. Yeah.
my
Property
Renoirs,
insurance.
yep.
Yeah.
At some point, you get to you reach a point where you don't need life insurance anymore, because the purpose of the life insurance was to create the instant estate, and hopefully you've created it on your own, right? So that potentially goes by the wayside.
Wait. Did you just say that life insurance purpose is to create the instant estate? That's coming from an estate planning attorney.
Well,
right there.
well. I mean, hey, if the shoe fits,
Whoa,
the shoe fits.
Look
hey.
what we have here.
Hey, I'm
Instant
sorry
estate.
for your loss, but look at the instant estate.
Instant
It's
estate.
unbelievable.
You need some estate planning. I've never heard that. Write that one down.
Put that on a T-shirt.
Creating the instant
Marsden Law,
estate.
creating instant estates
If you've had
since 2011. That's right.
It's like
That's right.
Life insurance and lottery winners. Instant estate. Hey, come talk to me. Here we go.
Let's get some planning done, right?
Oh, I love it.
So now you've let's say you're 60. You're in the right demographic to start consideration of a long-term care policy where it's a little bit affordable and things don't get too crazy, and hopefully it's before some medical issues arise that make the premiums a little bit more exorbitant. Maximize your coverage opportunity.
Yeah.
And it may be worth it to say, look, normally we would put off a big distribution or a sizable distribution from our IRA until 70 and a half or 72, wherever it shakes out at, because we've been listening to all these people. You know what? Why don't we take a distribution now, use that money to fund some long-term care insurance as kind of a one-pay arrangement, and then we're done.
Mm-hmm.
Then we don't have to worry about it. And then you just put the IRA back on the shelf, put the retirement account back on the shelf, and let it do its thing, right? Let it keep going. And in some cases, you get a little bit market cooperation. You could sort of make some of that back, relatively reasonably.
And what happens, right? So what's the ramifications if you're, for whatever you're going to take a larger distribution?
Sure.
What happens? And we covered a little bit of it, right? So if I'm going to take, let's say we use $100,000 as the example.
Yeah.
So remember, it's pre-tax money, so I got to pay taxes on this, right?
Yep.
If my income, let's say my annual income was $150,000 from my other sources between a pension, Social Security, other money that I'm taking out.
Sure.
I'm now added another $100,000. So now my income for that year is going to be $250,000.
That's right.
So that could bring me into a higher tax. So it means I'm going to pay higher taxes on a portion of that money that I'm taking distribution from.
You are, but because you're still working, because hopefully you've done some other things, you may find yourself in the very unusual situation of saying to the person guiding you through this transaction, not only do I want to take the distribution to actually fund a long-term care insurance situation, but I can pay the tax obligation out of pocket, right? You might be able to, because you're still working, and so you might be able to say, look, don't, if I want $100 out of my IRA, give me $100. Don't give me $100 and then knock it down because of the tax. Just give me the $100, and I'll deal with the taxes later because I know I'll have the resources. So now you're basically going to end up paying $20,000, if you will, for a long-term care insurance policy. So that's part of the discussion. I digress. Go ahead.
I love it when my attorney friend gets in and does his tax planning, because I do find you get excited about tax planning.
I do a little bit. It's fun. It's fun.
So I've taken my distribution, and so I've increased my, so I know that my taxes are going to go up. I know that I have to pay taxes on this money. And I know that because of my age, because I'm, as Jay in our example, I'm outside of the 59 and a half, so I'm over 59 and a half, so I'm 60 years old, so I'm not going to pay a penalty.
Yep.
So that because oftentimes that's the big thing about these qualified accounts is the big kind of like roadblock is that if you take a distribution before age 59 and a half, you have to pay a 10% penalty. So it's going to cost you whatever, 10%.
To get your own money, it's a hassle.
10%, it's a hassle, and oftentimes it's not worth it.
That's
oftentimes, not every time, but often, most times, in most situations, it's probably not worth it. So here I am, and again, if we back up and say, okay, so why are we doing this? So in our example, we're doing it to pay for a long-term care insurance, to buy long-term care insurance, and the way these particular policies work is it's a one-time pay, right? So it's a one-time dump in, and now you have this long-term care insurance. You never have to put any more money into it. There's probably some sort of a death benefit that's involved. So you have the potential to regain some or all of your money, or maybe even more than what you initially put in, should you never use it as a long-term care insurance policy.
That's right. So in a sense, you're redeploying $100,000 from your retirement account into a long-term care bucket, basically.
Yeah. So what are the other ramifications? The other ramifications is that me as if I'm your retirement planner, the first thing I'm going to say is, can you afford to do this?
Right.
Can you afford? Is this going to affect your? Was I counting on this $100,000, or were you counting on this $100,000 to be part of your retirement income? Is this what you're like? Whoa! You're not spending your retirement in order to buy this insurance.
That's right. What impact is this going to have on your? And this goes back to where we've addressed the idea that our long-term care concerns outweigh, for any number of reasons. We feel like they're a little bit more.
Well, not outweigh, but they're
bigger. They're bigger than just retirement income. They're part of the discussion.
Yeah.
Yep,
and it could be that you're just in a position where you have that much liquidity, that you're in a position where some people, they're like, yeah, I care about long-term care. I care about the ramifications of it. I just can't afford a long-term care insurance policy because I just can't afford it.
Yeah,
I don't have the resources to do it. But these people, in this example, maybe they do. They have the resources to do it, and they say, okay, it's not going to affect my retirement. It's not going to affect my overall retirement. I mean, it will, but it's not something that I absolutely need in order to retire according to my plan. But now I can essentially, I'm buying, and what all these long-term care policies are. It's a bucket of money, right?
Yep.
It's a bucket of money that, should I find myself or my wife find herself in a long-term care situation, that now we can use this bucket of money to draw on to help augment the cost for the long-term care.
Yeah, and that's the idea. The idea is you're doing it. It's a window, right? This might not work if you're 75. This might not. This is kind of like a.
Why not? Because it could be too expensive.
Too expensive. You're not going to get the coverage. You're not going to qualify for the long-term care piece. If you did get the coverage, the number you'd have to pull out becomes astronomical. It affects all those other things. It affects your Medicare premiums and things like this. We're talking about this as like a early, right after the 59 and a half. Do I have enough money to make the withdrawal? Do I have enough money to use the money to buy me some long-term care insurance that's going to address this long-term care concern that is real? It's not that it's never not real, but it's not, you're not just making it up. And does my retirement account have the ability to recover from this? I think that's what you were just reflecting on.
Well, maybe not recover, but maybe can I afford to do it? Can I afford to take a piece out of it, right?
That's
so
right.
So if I have, $5 million in my retirement account, I may feel like
Not a big deal.
I may feel like I can afford to do this.
Yeah.
If I have $1 million in my retirement account, if I have, it may be, or let's say I have, 300,000 in my retirement account. However, maybe I have 5 income properties
That's
that are going to,
Yeah,
so
it's very case specific.
yeah, it's all gonna be driven by what I can, how I can afford it. And again, that's why, all of this is kind of considered in its entirety, because in the beginning of this we talked about, I have this large IRA. What are some of the things that I can use? How can I use this thing? What's the best way to deploy this thing in order to kind of accomplish these long-term care potential goals that we may have?
Yeah, so you button that piece of it up. So we've talked about using just either accelerating your distributions, kind of figuring out we're going to use the retirement money as our lifestyle money, and then we've protected these other taxable assets, right? That's our legacy. The IRA is not going to be our legacy money, but the other taxable assets and real estate, they are going to be our legacy because it's easier to do the planning with. Part 2 is, do I consider the impact, considering all the impacts of a distribution from my retirement account, if it makes sense, around a certain time frame, at a certain age window, to use that money to actually go ahead and pay for a long-term care insurance policy and redeploy some assets that way. And then the third option, again, I believe we discussed this on the show at some point, maybe not as a package like this, is the idea of choosing the non-conventional distribution schedule of IRA monies if somebody passes away in spousal situations, right? Where husbands and wives are hardwired for all the obvious reasons to leave each other large sums of money, right? Yeah. My IRA is going to become my husband's IRA is going to become mine. That tends to be the arrangement, if you will. And there's a real discussion around, at some point, does that not make sense anymore, right? At some point, we don't necessarily have to have all of the monies come back and forth to each other, because potentially all you're doing is making an okay problem a bigger problem by inheriting, by spousal inheritance of large IRA balances.
So what's the bigger problem in that sense?
Well, the bigger problem is, remember, we're talking long-term care. So the bigger problem is that the person who inherits the money may have their own long-term care challenges.
Yep.
And having somebody inherit $800,000 when, without the spousal unit, the probability or the potential of a nursing home looms a little bit larger, that becomes the issue. The issue is, if somebody's trying to figure out how they're going to pay for their long-term care costs, do we want somebody inheriting substantial amounts of money, or do we potentially want to redeploy some of those resources? So instead of somebody inheriting a $600,000 or an $800,000 IRA, maybe they need to only inherit half of it, right? And maybe the other half can go to kids, or can go to grandkids. It can go to other places that sort of work along the lines of helping somebody, see their legacy at work and actually see the lifetime accomplishments that you want to pass on to the next generation actually be put into play, while at the same time not creating a bigger problem. Because remember, when you have spousal situations, you have a little bit more flexibility around long-term care and Medicaid planning. And if something happens to one of the spouses, all the rules change and they become a little bit more unforgivable.
So I have a question for you, and then we'll go take a quick break. So my question is, so in that situation, this is a real question. In that situation where if we're married and I have and my IRA, I'm gonna, instead of, if I pass away, you'll inherit, it'll become your IRA. What you're saying is you're going to go ahead and we're going to start spending it. We're going to start distributing it somewhere. We're going to spend the money, or we're going to gift the money away. Is that the?
What I'm talking about is just from a beneficiary perspective.
Yeah.
When somebody's health is a little more compromised, you find a situation where, for example, somebody's spouse has the bulk of the retirement money, and they're the one that we're concerned about their health, and rather than have all of the money just naturally pass over to the spouse, instead of somebody's spouse inheriting $1 million, maybe the spouse inherits $500,000, and the other $500 gets deployed to what would normally be the contingent beneficiaries, and they get the money now, as opposed to having to sort of wait out mom and dad, because the idea is, maybe my parents, maybe my mother or my father don't need to have all of the money come to them, because all it does is now create more problems because again,
Because if
it
that
stays in the IRA.
yeah,
Nothing we can do about it,
yeah,
right?
and if that surviving spouse does end up in a long-term care situation, then that money could
That's right.
could theoretically be spent for long-term care when it didn't.
That's right.
when
It
it
becomes a
wouldn't
little bit more tied up, a little bit more, a little bit less flexible in terms of how your spending goes. And you might say, look, based on based on the pension and the Social Security and the lifestyles that are being, that somebody's, what they're hanging around and spending their money on, they might not need to inherit $1 million, right? 500
Yeah.
might get them there, 300 might get them there. I don't really answer that.
Yeah, and the important thing to understand is that this isn't as if one or both of the spouses are looking down the business end of a long-term care situation imminently, right?
That's right.
This is, so if you think, oh no, my wife is my husband's sick and I'm the husband and my wife is potentially could be in a long-term care situation sooner rather than later because she's declining or whatever, and I know I'm checking out pretty soon, then it's kind of like too late. Then it's kind of like then because at that point, if I end up if the money beneficiaries to my kids, then my wife could potentially need that money. I think I'm tracking with you.
Well, I think what we're suggesting is this is a somewhat unconventional, not in a super negative way, but this is just something that most people are just hardwired to make sure that their significant other is the person who inherits all of their retirement money, all of their money, and there may be a reason for that to not make sense. And the reason I'm saying it is it's different than if you're sitting around hobnobbing with your contemporaries and they're all saying, well, what do you mean your wife's not your beneficiary of your IRA? What do you mean your husband's not your beneficiary of your IRA? Yeah. Well, there's a reason for that.
Don't you love her anymore?
That's right. Who is the beneficiary? There's a reason that just doing that might not make sense anymore. There's a reason to do it differently.
All right, let's take a quick break and we'll be right back and we'll wrap this up and everybody will understand. Everybody will learn.
Tie it all up.
Yeah, tie it all. All right, we'll be right back. Happy Memorial Day, by the way. Yeah, because it's right now.
And we're back at my FM 101.3, Jay Marsden with the Marsden Law Group, John Drohan, Main Effort Financial. We're talking all things big retirement, long-term care planning challenges.
It is a challenge, right?
It can be. Again, the discussion is really that the long-term care issue is looming large, and it's got some real traction, and we're trying to figure out, what are we going to do? How are we going to handle this? What's the plan?
So the question that we're asking today is, could there be a situation where we spend we distribute our IRA money, our qualified money, sooner rather than later, or differently rather than have the traditional way of like my wife inherits my whole IRA or vice versa, I inherit her whole IRA. And the first reason you would do this is because if she doesn't need it, or I don't need it. Like she doesn't. Because there's other assets. There's other means of income that she's going to be able. So no one plans that they're going to. Oh yeah, and when I turn 75, I'm going to check into the nursing home. No one plans for that, but. And it may never happen. You may be, 99 years old and getting in your car and driving down, to your job or whatever. That could theoretically could still be happening. So you don't know exactly what's going to happen, but. Your situation, your particular retirement plan, there's other pieces that are in place already where you're not necessarily going to need all of that IRA money to help continue if one of the people passes away, and you've also taken into consideration the long-term care piece. So that's what I want to just quickly review with everybody. So you had mentioned this before about so there's some as opposed to the IRA or that qualified money, there's other assets and there's other ways you can protect those from potential long-term care situations. So let's talk about some of those other assets, like some of the more obvious. We kind of briefly mentioned like if I own property, rental income, or my primary residence. So how do I protect that?
So we always tell people real estate is one of the easiest things, if you will, to protect because you got to live somewhere, right? You got to have a roof over your head, right? Whether it's your primary residence. Whether it's a place down the
or
cave,
unless you're crashing at Christians,
couch surfing at Christians, whatever you're thinking about doing. But the idea is that whether you want to change the way you own property so that you're adding people to your deed to kind of get the process to move along on some of these look back periods. The 5-year one is the big one that everybody's most concerned about from a Medicaid perspective. So you can change the way you're the property titled, or you go down the trust route. You do an irrevocable trust. You get the property out of your name. You give it to the kids, to be your trustees. And that's something that you can do, and it doesn't feel. We always talk about this in the show. It doesn't feel different,
No.
or it shouldn't feel different, right?
No, I'm still living in the same place.
Exactly. You're
Yeah,
still going
I'm
to cut the
s-
lawn. Still
and
going to
guess who's still paying the taxes?
That's
It's me, right?
That's
Yeah.
The lights still work. The
Yep.
coffee. You don't have to ask anybody to use the coffee maker. It's all your stuff.
You don't have to ask anybody to go to the bathroom.
That's right.
Not like in the
do whatever you
joint.
want to
Yeah.
do. That's right. You can do whatever you want to. But it's in an irrevocable trust, and so this is where you can target some taxable assets to get them out of your name and get them into something else, and then you're leaving behind the assets, the retirement assets, that are the most difficult or the more difficult to do some planning with. And you say,
Yeah.
look, the legacy is there, right? Rather than the legacy be, some of my IRA money because I didn't really aggressively do any drawdown on it, and some of it might be up for grabs if we run into this nursing home situation, and you get some of these other assets. You're making a definitive decision to say, look, this is our legacy, and this is our lunch money, right?
Yeah.
That's the difference, right? And spending it down like that is a very targeted way to be able to say, look, we did our work, right? We did our homework. We did some intentional planning. We figured out what things we wanted to make sure went where they were supposed to go, and we kept enough back to live our life. And there's some retirement income planning in there. That's what working with your financial advisor is going to really help you sharpen the pencil on this to say, how much can we, sort of delegate, get rid of, put in some, whatever terminology you want to use, but it's a way to sort of do it in a way that feels good, not, I just gave away $500,000. I just gave away a piece of property and I'm really nervous about it. This is a little bit more intentional so that when all the paperwork is signed, you can say, look, my life is no different.
Yeah.
Nothing's different. Nothing feels different, right? I'm still going to get a beach sticker. I'm still going to be able to cut the lawn. I'm still going to do everything I need to do. It's just not mine anymore. But it's going where I want it to go.
Yeah,
And that's the big
it's not
difference.
necessarily mine, but it's not necessarily. I haven't lost it.
No,
right?
no.
And so, and when you look at this, when you look at that situation, you say, okay, because oftentimes, especially with like liquid money, like with cash. So if I have $200,000 in a bank account, right?
Yeah.
And I'm like, I always have $200,000 in a bank account.
There's a physical response to seeing that statement come in every month, right? Yes,
Right.
absolutely
and,
right.
and,
there
it-
is.
and it's real. It's not a joke.
It's not
I mean,
made up. No,
it's not.
no.
It's not something you're like, oh well, this is it's silly. No, it's like, one of the things that when I get up in the morning, and we always joke about this with our clients, like, look, especially clients that sit on a lot of cash. So I'm like, so every night when you go to bed, you know, if I need to write a $100,000 check tomorrow, I can do it. And not that you would ever theoretically have to do that,
Right.
but that makes people sleep at night, and they've had that security, and maybe it's because they came from a life, with their, growing up where they didn't have money,
Sure.
right,
Yeah.
and so where they didn't have the, where
There's
they
an
didn't know.
emotional connection.
Yeah, and so we're not saying that we're not minimizing that at all.
No.
So, but it's the idea of, and I think one of the ways I think about it is that you kind of build this plan and say, okay, I'm going to put, say, my house into a real estate trust. I'm going to put a bunch of my non-IRA money into an irrevocable trust. Now, remember, just because I give that non-IRA money to an irrevocable trust, what can I do? I can draw income from that, right?
Yep.
I can generate income from that. So if I put $500,000, brokerage account into an irrevocable trust, guess what? I can take the income off of that.
Yes,
off
I
of
can.
that.
That's right.
And it doesn't change the irrevocability of that trust, right?
That's right. That's
so,
right. Yep.
So when it comes, so again, we're doing this for if and when, mostly if, potentially when, I end up in a long-term care situation.
Yep.
Right.
Yeah.
And remember, we said this earlier in the show. If I get in a long-term care situation, somebody's going to pay for it, whether it be me or whether it be the state. And the way it works is, I pay for it until I no longer have any money or until I've reached the minimum threshold, and then I apply for Medicaid, and Medicaid says, okay, we'll take care of the rest.
Yeah, that's right. That's right.
And so the idea of, when you're doing this retirement planning and you have that big IRA, you say, okay, I'm going to protect that stuff. So no matter what, that stuff's going to get passed on.
It's going to
as a
hopefully go
legacy.
where I want it to go.
Yep.
That's my legacy.
Yep.
That's right.
And I'm going to draw maybe I'm drawing income from here, maybe I'm drawing income from rental property, and I'm drawing income from my IRA.
Yeah.
And then guess what? This is, and if I never go to a nursing home, this is what my
Also
projectol
gonna get
looks
it.
like.
Absolutely right. Yep.
Right?
Absolutely.
If I never go to a nursing home, but if I do go to a nursing home, then guess what? all of a sudden my bills are going to be a lot bigger. My cost, it's going to cost me a lot more to live because I'm paying $10,000 a month. So guess what? That money's going to come from, and I have it's radio here, but that money's going to come from my big IRA, and that's going to draw down a lot faster than I thought it was going to draw down, than I had planned if I didn't go into a nursing home.
That's
but
right.
you know what? Like we said, eventually, it's all going to get paid for.
Right.
I draw that down, and then let's say unfortunately, I'm in a nursing home long enough where I draw all that IRA money down to zero,
Right.
and I don't have any money. And but wait a minute, you have 500. No, that was in an irrevocable trust. I put that in 7 years ago.
That's right.
My house has been in a real estate trust. That's out of my name. So right now, when I apply to Medicaid, I don't have any. I don't have any assets.
Right. Or if you do have assets, you have the retirement assets, which you have made a decision that says, look, I'm going to leave these assets exposed.
Sure.
Right. And to your point, something happens, they go exactly where I want them to go. Something happens to me. But if I'm in a long-term care situation,
I may spend them.
And that's okay, because you know why it's okay? For the reasons that you just said, because I've already done $1 million worth of legacy planning, and that's already been put in the box and locked up, and it's not even on the table anymore as an issue. That's my legacy. I wanted to leave a legacy, but I didn't want to impoverish myself. I wanted to live my life. Nobody wants to sit home on Friday and say, geez, I'd love to go for dinner tonight, but I put all my money in my irrevocable trust and I can't go anywhere, right? Yeah. Nobody wants that.
And that's what this isn't like flippant, like do this on the back of a napkin kind of plan. This is careful planning.
Yes, this is thoughtfulness. This is thoughtful.
And you have to be thoughtful, and you have to work through the scenarios, and it has to be for the right person. But we're just saying that there's a potential that you might go against that counterintuitive to spend your IRA sooner rather than later, in the case of a long-term care plan.
And again, the knee-jerk reaction, you've talked about this on the show a million times, the knee-jerk reaction is
You didn't call me a jerk.
No. The knee-jerk reaction is to lock that thing up and don't take as little of it as possible. Just that minimum. You feel like you're a failure if you take more than the minimum. Right? Oh my God, I'm taking more than the minimum.
No, I'm paying Uncle Sam.
What have I done wrong, right? Well, here's what you've done wrong. You've spent it because that's what you planned on, but you're also leaving a legacy with other aspects of your portfolio. All right. That's the idea.
That's it. That's all you need to know.
Hope you took good notes. Yeah. You can start driving again.
Yep, you get back on the road.
Yeah.
Right?
Actually, you're probably sitting in traffic trying to get on the Cape right now, so you're able to write the entire thing down.
In fact, you were standing outside your car.
And you're still 6 miles from the bridge. Yeah. So good luck.
All right.
We'll see you on the other side.
Everybody have a happy Memorial Day. That's Memorial Day.
Hats off to all of our veterans. Hats off to everybody the services have served.
Happy Memorial Day. Enjoy. Be careful. Be safe out there. And we'll see everybody next week on Money in the Law.
You got it.
See you next week.
See you then.